I think if you saw one of the systemically important banks in the United States exposed to real difficulty, what you would see is a contagion. And I don't think that the FDIC could preside over that.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with the man, the myth, the legend, Rick Rule. Rick, thanks for coming back on the show.
Thank you for having me back, Steve. I appreciate it.
Yes, sir. Yes, sir. I got to say, we just had your silver boot camp, and we had your uranium boot camp before that. Both of them, you just knocked them out of the park. And you have a new one coming up, your electric and battery metals boot camp.
We do. You know, Steve, for years I've offered to rank people's portfolios as they came in. There have been two advantages to me for doing that. One, I've learned an awful lot about how people invest. But the other thing is that I offer up boot camps depending on what my audience asked me to do. We had the uranium boot camp because more people wanted to talk about uranium than anything else then. We had the silver boot camp because silver finished in second place. Recently, we did a poll of our audience and asked what they'd like next, and they said electric and battery metals. So whatever the market wants, provided that we're qualified to comment, that's what we do. You will, of course, never see a Bitcoin boot camp out of me. You know, it's constrained to something that I know about, but certainly within the realm of what we know about, the customer always wins. So the the electric and battery metals is an area that people are very, very interested in, and in many senses don't know much about. So we're really looking forward to producing a product that will allow people to come away much, much, much better versed in the topic than they were before they heard it.
So I imagine the main focus is probably going to be copper, or am I off here?
We will certainly talk about copper. That's the metal that most people understand the most. And so we'll probably need to delve into the copper market less than we will other materials. It's also, however, the largest and most investable space. So we're certainly not going to disregard copper. I have a personal fondness for copper because copper exploration, successful copper exploration, has made me so much money in the last 4 decades. But we think there's a lot of room to talk about cobalt. We think there's a lot of misinformation around lithium. There are also some lesser known minerals that have very profitable histories and trajectories. An example of that would be vanadium. And the sector in the market that probably has the most misinformation circling it is rare earths. So this will be, I think, a very good information product, although one that people who sit through 8 hours of will be very, very, very tired and will have worked very, very hard by the end of it. You know from our prior boot camps, but particularly the uranium boot camp, that these are very information-dense products. They're not entertainment products. They're really educational products. And I think that the electric and battery metals boot camp will be particularly, I guess the right word is difficult. I mean, I wouldn't encourage people to come to this who view it as a substitute for Major League Baseball or something like this. This will not be an entertainment product.
I am looking forward to it. We will have a link down in the show notes. And if you want to support the show, use the link. Rick has been nice enough to kick a little bit back to the show. Won't cost you an extra dime, and it's a win-win. So looking forward to that, Rick. I love your boot camp, so keep them coming. Okay, we got a lot of questions here. I got 5 pages worth. I don't know that we'll be able to get to all of them. I should have asked you before. Do you have a hard out?
Nope. Well, an hour.
Okay. All right. Okay, we got a lot of questions on the recent banking crisis. So to start off, from GPT, ask Rick to give his thoughts on the current banking crisis. I'm sure he'll put it eloquently, and then the Rick Rhetoric account can tweet it for us.
The roots of the banking crisis probably go all the way back to the history of the FDIC, which is to say, we, as a nation, decided that we would institutionalize risk by guaranteeing deposits. What that means is that the onus of bank safety is put on the regulators, who sometimes fail, rather than the investor. We have to take into account the world as it is, as opposed to the world as it ought to be, because most people don't want to work. They want somebody else to assume their risk. Most people are capitalists when it's in their interest, and socialists every other time. And that's what federal deposit insurance is. That notwithstanding, both the regulators and individual investors need to look for some very simple guidelines in banking. The first is that the bank must be well capitalized. The FDIC regards a bank with a 7% equity slice, which is to say a bank that's leveraged over 9-to-1 to be well capitalized. I personally like the number 10 as opposed to the number 7. I want a well-capitalized bank to actually be well-capitalized. Silicon Valley Bank's problem wasn't so much capitalization, however, primary capitalization, as it was their capital stack, which is to say that they invested rather heavily in longer-term obligations, looking for marginally high interest yields, but they funded that with very short-term, very hot deposits. And the consequence was, when interest rates rose and they had to market their long-term obligations to market, the funding mismatch became fairly obvious, and they had deposit withdrawals. Those deposit withdrawals took place in the face of a deposit base that was also structurally unsound. In effect, that over 97% of the deposits were corporate deposits, particularly from technology companies and venture capital firms. And as the market for venture capital investing slowed down, the influx of new deposits slowed at the same time that cash outflows to depositors to sustain their operations increased. So there was a classic mismatch between assets and liabilities, something that every aspiring banker learns about in second-year university and money and banking. But these guys, of course, were masters of the universe. And I'm not trying to say they were bad bankers. They weren't bad bankers. It's just that they lived through 40 years of economically benign times. And the consequence of that is that they came to believe that they were smarter than they were.
Essentially, they borrowed short and lent long, right? So they had bonds that are paying them 1.5%, but when the value of that goes down because the interest rate goes up, and then everyone tries to pull out their money at the same time, you're going to have a bad time.
Exactly. It was a set of circumstances where everything that could go wrong did go wrong in a fairly brief period of time. Their traditional depositors needed to take money out of the business, out of the bank to sustain their own businesses. So new deposits were short. The interest rate rose precipitously, which, as you say, decimated the capital value of their bond portfolio, and exacerbated what was an existing funding crisis. It was too bad, but it's the sort of thing that you are not supposed to, as a banker, push the thing to the very edge. That's not what you're supposed to do. The equity that you have as a banker in your bank is, in effect, an insurance policy for your depositors. And they were insufficiently insured by a wide margin.
Okay, from Diogen. Can the U.S. government really stand behind any or all of the 4 U.S. biggest banks if they get in trouble?
No. I think if you saw one of the systemically important banks in the United States exposed to real difficulty, what you would see is a contagion. And I don't think that the FDIC could preside over that. I also believe now that confidence is shaken enough that Congress' ability to strengthen the FDIC with quantitative easing, which is to say newly created currency units, probably isn't something that would sit well with the populace. Your listeners need to understand, however, that the big four banks are in relatively robust financial conditions, financial condition, if the economy doesn't change too much. The mismatch, the time mismatch between assets and liabilities, particularly given the incredible influx of deposits that the big banks have enjoyed since the blowup at Sovereign and Silicon Valley Bank, I would suspect is sufficient to keep the largest banks in the country solvent. Where the sin may lie, and I don't want this to be a YouTube headline, but where the sin may lie is in the smaller community banks that can't look to be saved in the too big to fail doctrine, and who were similarly greedy with regards to lengthening maturities in return for higher yield relative to their deposit base. I'm not saying that's going to occur. What I'm trying to say is that across the country, it is likely that there were banking teams who were not as smart as they believed themselves to be, and banking teams who believed that the artificially low interest rates that they enjoyed for the last 40 years would continue ad infinitum. You may know, Steve, that I've been part of starting several banks, and ironically, I'm in the process of doing that now. There was a time in my youth, which is to say before I turned 30, that I probably believed I was substantially smarter than I was. Time, however, has humbled me. And I mean, I love the banking business. It's a really, really, really good business. A good enough business that I've often styled myself at conferences a used money salesman. But it's one where if you don't follow the basic guidelines somewhat well, because of the leverage involved, it can expose you to substantial risks. And my suspicion is, if you look across the length and breadth of banking in the United States, that there are still probably some unexploded bombs to explode.
I was watching an interview by Janet Yellen, and she was basically getting grilled. But did you see that one?
No, I can't stand to watch her any longer.
Tough. It's not an easy watch. But she was getting grilled by a senator from Oklahoma. His name's escaping me at the moment. Lankford, I think. Anyways, he basically said, so who decides whether, what's going to keep large depositors from moving their money from these small community banks into big banks? And she basically said that, well, myself, the president, the FDIC, and the Fed decides which banks make it and which ones don't. And that was it.
Well, for her, that's strangely honest and straightforward.
Yeah.
Usually, I would say that she is either malinformed or misinformed. But I happen to agree with that statement. I personally believe that there are many local and community banks. I'm thinking about banks like Farmers and Merchants Bank of California or First National Bank of Alaska that are substantially better capitalized than the major banks and that are run by truly prudent human beings, which is to say they're great businesses. And they are in fact, better places to be a depositor. They, however, do not have the political sway that, say, a JP Morgan Chase might have.
Okay. Interesting. Okay. This one's from Firm Investments Group. Does he see a liquidity crisis similar to 2020 brewing that will cause banks to dump assets like gold in order to gain liquidity to remain solvent? If not, what other reasons could cause one last gold sell-off? Lastly, does he plan on joining the Fed Now system when it's implemented?
Do I plan on joining the Fed Now system? No. Both for practical and for moral reasons. The idea that I would be an instrument of Fed policy is anathematic to me, so I wouldn't do it. What might cause the gold price to fall? Two things: a real near-term liquidity crisis, where not just banks, but living, breathing human beings would be forced as a consequence of margin, as an example, to sell anything that had a bid. And gold always has a bid. The other thing that could cause gold to fall probably hasn't occurred to your listener. Maybe it has. That would be if the big thinkers, if the powers that be, accidentally or less likely on purpose, actually engineered a soft landing, which is to say, if the consumer price index were to fall and we were able to keep deposit yields and treasury yields high enough that we actually had a real yield again on the US 10-year treasury. By the way, I think this is highly unlikely. Yeah. With the 10-year treasury yielding something like 4 and the CPI stated rate of inflation at 7.5, you need to understand that you're still suffering 350 basis point. Can you still hear me?
Yeah.
Sorry, 350 basis point negative real yield. So I don't believe for a second, I shouldn't say for a second, I don't believe that they will be able to engineer a soft enough landing that the US 10-year treasury will generate a positive real yield. But if they were able to come close, I think that would decimate the gold price. And sadly, I forget what the first question was.
Do you think that the reasons gold could sell off, and then is there something brewing that they could have to sell all this gold that they've been buying in the last year? And you answered that.
I'm not concerned about the financial institutions selling gold particularly. I'm concerned about a 2008 style liquidity event where individuals were forced to sell their gold as a consequence of either fear or margin calls or both.
Okay, this is from our super fan, Carlos from Spain. Hi, Steve. Question for Mr. Rule. Why does he think that central banks are buying gold in a big way? What is behind it? A monetary reset? Thank you.
I think central banks are buying gold because they don't trust each other. I think central banks are buying gold because, unfortunately for us, they got it right this time. I think when central banks look at the composition of their own assets and liabilities, they assume that other central bankers are in as bad shape as they are. So rather than buying the obligation of other central banks, they buy classically a financial asset that isn't simultaneously a liability to somebody else. Some central banks also, I think, are buying gold because they don't trust the United States. They've seen the weaponization of the US and the international financial services sector to export US values to other countries on an extraterritorial basis. I think if you were, as an example, running the Chinese central bank, the idea that you would accept a negative real interest rate while at the same time subsidizing a culture that was trying to put you out of business is something that you might find anathematic. I certainly know that Iran feels the same thing. Russia feels the same thing. Increasingly, Saudi Arabia feels the same thing. Governments around the world are sick of the imposition of US politics and culture extraterritorially, and particularly they're sick of doing it for a negative real yield. Why would you subsidize somebody who is trying to impose their will at you while accepting a 350 basis point negative real yield? I think the banks are buying gold simply because they understand their own self-interest, and also collaterally because they can both add and subtract. And the arithmetic around fiat obligations, be they euros, renminbi, or dollars, are lousy.
Yeah. Okay, from Martin McDade. How imminent is it we start questioning just how worthwhile our US Treasuries are? When do they become our albatross? Well, they can print it, right? So
I think I just took you through the arithmetic. Let's look just for fun one more time at the US 10-year Treasury, Steve. We've done this several times. The US government solemnly promises to deprive you of 3.5% of your wealth, compounded every year for 10 years. Maybe the first promise in my lifetime that I expect my government to keep. They pay you about 400 basis points in a currency where the purchasing power is declining by 7.5% or 750 basis points a year. In other words, they solemnly swear to reduce your purchasing power over 10 years. And I believe them. My friend Jim Grant calls that return-free risk. Now, I personally am a substantial holder of Treasury securities with maturities in 1 year or less. I do it understanding that I'm losing purchasing power, but I love liquidity. But the idea that somebody would buy a long-dated U.S. note, it just defies arithmetic for me, Steve.
Yeah, I started doing the same thing after the VRIC conference when everyone was like, well, 4 or 5% ain't bad. It's better than zero, you know? And so I started putting them on a 1 month treasuries that roll to maturity in 1 week time frame. So then I've always got about, I think right now the portfolio is about 25% cash. And so I keep 5% of that cash in case something happens during the week that I need to take advantage of. And the other 20%, every 5%, you know, matures on a weekly basis.
Well, Steve, that's an important thing to do. I regard the negative current yield on short-term obligations as a form of option payment.
Yeah.
I've been through 3 or 4 market, illiquidity events in my life. And in the first one, I was unprepared, but I was never unprepared after that. So the idea that you have cash, that you have liquidity when no one else does, or when most people don't, means that you have the tools and hopefully the courage to take advantage of a circumstance rather than being taken advantage of by the circumstance. But by all means, keep the maturity safe. Ironically, right now, short-term yields are higher than long-term yields. This makes absolutely no sense to me, but it's a circumstance that delights me.
Yep. Okay. Andrew, the fundamentals for precious metals couldn't be stronger, but money still goes into crypto more than gold and silver during the recent banking crisis. Is this an indication of a paradigm shift? With this generation of investors, have they been conditioned to ignore gold and silver?
Yes, I think. What crypto doesn't offer, as far as I'm concerned, is a 2,000-year track record. But after 40 benign years, people don't care much about that 2,000-year track record. I personally do. I have this sense of crypto that the 2 principal advantages of it are anonymity, which most of the crypto community would like to get rid of. In other words, to have it more acceptable, and very low friction. To me, the chief way that precious metals compete is that their value doesn't come through the network effect. It comes because precious metals have intrinsic value of their own, separate and apart from the precious metals community. So from my own standpoint, I'm drawn back to what Aristotle had said about precious metals, which is to say that they are probably the only financial asset with intrinsic value that is an asset without simultaneously being somebody else's liability. It isn't a promise to pay, it's payment itself. And my suspicion is that, very much like the decade of the 70s, if we have an experience with the set of circumstances that we had in the 1970s, where young people's faith is shaken to the core, that those people will rediscover gold. I remember myself at age 18 or 19, I wasn't particularly a gold bug. I probably couldn't spell gold. But there was a circumstance that occurred in the late 60s and the early 70s, stagflation among them, that caused me to understand that the big thinkers, the government big thinkers, weren't my friends. And that and the realization that gold had functioned as a form of personalized insurance against society's promises to pay caused me to receive my gold education in the 1970s. I have a strong suspicion that young people now will get to learn the same lesson, however unpleasant that lesson may be.
I think so. We'll see. We'll see. Okay, from Dan. An uncomfortable question in light of some Canadian and US government policies in the last couple of years. What is the likelihood of some intervention with Sprott physical accounts if financial conditions really deteriorate?
I think the probability of that is low. I think that the government has learned that if they steal from you indirectly, it's politically popular. That is to say, if they depreciate the value of your currency, if they drive down nominal interest rates, if they subsidize spenders at the expense of savers, they get reelected. If they try to steal from you directly, believe me, I've talked to some of these big thinkers. They are well aware of the fact that there are 400 million guns in private circulation in the United States. And there's a level to which, beyond which you shouldn't push the voter, particularly when the voter loves it when you steal from them by inflation and by depreciating the value of your savings. Why would they choose to steal from you indirectly and risk your ire when they can steal from you indirectly and enjoy popularity with you?
Yeah. Okay. All right. On to some company questions here. Got some feedback that if we could remember, I always forget to ask you, remember to include your ranking if we're talking about a specific company. Okay. Rick, what are your favorite oil royalty companies? All right, we're going to split that one into 2 episodes. Support the show, hit the like and the subscribe, and then hit the little bell notification icon so you'll be notified of Rick Rule Part 2. All of Rick's links will be in the show notes down below. And next episode, we discuss oil, vanadium, a deep dive into uranium, and how to leverage silver. Hope you guys got something out of this. Thank you for watching, and I will talk to you next time.